You are entering an investing state of mind the system doesn't want you in. The truth. You want answers? Michael Covel has them on the trend-following radio network. And now, reaching over 130 countries and territories, Michael Covel.
I first reached out to my guest today in 2005. It just struck me, and we talk about it in our conversation. 9 years ago. Damn. Time flies. Toby Crabel is my guest today. Crabel Capital Management. Short-term systematic trader. Quant. Very different than most of my world. Now, a lot of commonalities. Price action driven. Systems, models. Risk management. But Toby is working on a whole different time frame, turning his portfolio over typically in less than a day. But I still remember our first meeting. It was a great conversation. And what struck me about Toby was his philosophical nature. The competitive sports side, a former pro tennis player, but that philosophical nature. And then executing it in the systematic trading world. I thought it was such a unique story, then and today. I hope you enjoyed this conversation. Toby, Mike Covel.
Hi, Mike. How are you?
Man, it's been a long time. I think it could be 9 years since we spoke.
I think that's right. I think it was in the Virgin Islands, right?
Yeah, I was like, wow, where's time go? That's really scary.
It's a bit frightening.
Okay. I just hope they figure out this life extension soon before we leave. So. Yeah. Interview Ray Kurzweil. I think he's after it. So. Yeah. So how's it going?
It's okay. I keep working at it and improving a little bit incrementally. And those little gains help. So that the firm's going well. My family's good, and we've fully moved out from Wisconsin, and it's a good life. Playing a lot of tennis, and there's a lot of good things happening here.
Let me jump into the setup of tennis, but first I want to describe a few big picture points. I want to drive right into what you just mentioned. So the head of Crabel Capital, over $1 billion assets under management. Since 1992, your track record starts, but not an overnight success story. And I just checked on Amazon today to look at your book, Day Trading with Short-Term Price Patterns, priced at $981 for a new copy.
But low.
So, but here's where I want to go though. Before all of this, pro tennis player. I think you got as high as 280, or as low, I should say, 280 in the world. Talk to me about though, that experience of being such a competitive tennis player, the 8 hours a day for years practicing. Is there a direct translation to the competitive drive that you have in the asset management field, the fund management field?
I think it's a direct translation, actually. I mean, I refer to it all the time. It's an analogy for what I'm doing in my business and the way I approach things. So, especially in those early years of the track record, but it can be a good training ground if you take away from it the idea that we can always get better and we can improve at what we're doing. And the one thing that's very clear is there's losing days, and there's losing trades, and there's losing tennis matches, and how that's handled and what you take away from it is the most important thing. So that's I think for me is the key to longevity and the solace that I haven't always done that very well. I mean, in tennis, I think I stopped a little early. I had looking at the record, I had a lot more potential than I gave myself credit for. So one of the things I take away from that first career is that I'm not going to quit. So that's why, I mean, there's been some tough times in these markets and in my own business, and I just don't, first of all, I don't want to destroy anything that I have by having too big a drawdown. So we're very conservative with risk, and I think that permeates the firm. And then secondly, when you're there to fight for another day, you don't let yourself get overwhelmed by the tough times, the losses, the day-to-day grind of it. You try to elevate a little bit and keep my head about me when it comes to that.
I'm guessing from a tennis analogy, if we're going to stay there for just a moment, you would probably prefer the consistency of a track record. If I pull up Wikipedia and I look at Federer versus a Nadal. Nadal is fantastic, but he doesn't have, best that I can tell, the consistency is just, Federer's in a completely different league.
Yeah, I truly do admire, of course, both players, but Federer's, it's just incredible talent. But the way he plays, there's a conservation there of energy, I think, that will allow him to play, I think probably we'll see a lot longer than a lot of players. And there were others like that in the history of the game. I mean, Ken Rosewall played into his 40s and did very, very well. It doesn't happen as much anymore, but, I think of Pancho Gonzalez was in his 40s when I think he did very well at Wimbledon one year. I mean, if you're, I don't know if it's pacing yourself, but Nadal's passion is fantastic. You have to love the intensity that he brings to the game, and there's really something really important about that when you see it. But yeah, I mean, when I think of my careers, especially this one, I'm thinking lifelong. This is something that I really enjoy, and I'm just fascinated by markets and price movement and how to quantify that. It's my science. It's what I do. And there's hardly, I mean, you can train in other sciences and that'll help, but you got to really get in there and work with the market data and use your imagination. So yeah, this is a lifelong pursuit, Mike, and I think that I don't think I'd have it any other way. I'm not going anywhere.
Let me drive into this. So I want to break apart some trading aspects and details of how you approach the markets philosophically, etc. But I know when we talked years ago, you really thought that your space, and we had a nice long conversation comparing your style of trading to trend following, some of the quant trend following, and there were some commonalities, but your time frame was very different, and you painted a picture that you were in a pretty unique space, that you were very humble about it, but you were saying it was very difficult to compete with your strategies, whereas there definitely are, many more trend following traders out there, and still to this day. So I'm curious, do you still feel like you have this unique space, your firm, and its multiple strategies?
I think so. In the money management world, handling client capital, I think it is unique because most of the shops I think our evolution is we're moving shorter, and our holding periods are tending to be shorter. So with that lends itself to there's only so much in the way of assets that you can manage, and there's a demand for it if you're good at it. So you have to be careful. And what happens is I think there's some very good proprietary firms that have evolved into relatively short-term trading like us, or shorter. And the high-frequency firms are certainly an example of this. I think that they're primarily or almost exclusively high-frequency are prop firms. So they're using their own money and investing that, and instead of trading client capital. And it's understandable because of the capacity constraints that exist in the short-term area. But yes, it is unique because certainly in the money management field, there aren't a lot of us. What we do is we're trading primarily liquid instruments. We're a liquid product for clients. We We trade frequently. We're less than 1 day, and our holding period, on average, is a lot of turnover in the portfolio. It costs a lot. It costs a lot to run the business. Huge challenges in the execution area. So we really, it's not an area that I think is just not that because of how it's prohibitive with the cost. It's just an expensive proposition. So there's not a lot of people that are going into this. So, but I came by it honestly. I worked with a floor trader in the early '80s, and we had a joint account. In his account, he paid no commission. So I was led by the nose to be trading and to take profits intraday. That just stuck with me over the years. That's just what appealed to me after doing that. You're kind of hooked. So yeah, it is a unique area in the money management field for sure. There's plenty of prop firms though that do this, and those are our true competitors, I think. We think of where we're at on the planet. It's those prop firms that really stand out to us.
We spoke before. It was multiple diversified systems, applying them systematically across multiple different time frames. Where are you in your total number of systems these days?
Yeah, you can talk about the systems individually, and there's several thousand in the portfolio. Or you can talk about the ideas, which are broader conceptual frameworks that we work with. So, for instance, in my area of the portfolio that I oversee the strategies in particular, I'd say there's probably 25 conceptual frameworks that I'm working with there. And I think the rest of the portfolio managers in the firm think in the same way. So they have a broad conceptual framework, and then they apply it in particular with a strategy. And may even vary it slightly in the different markets, because markets are different. The universals apply throughout all markets, but there are particular aspects of each market that you should probably take into account. So what I like to say is that, the markets are the same in principle, but at the same time, they're different. So we're dealing with two sort of different formulations of what markets are. Do you optimize for each market? Well, not heavily, but yeah, there are variations for each market. And that may count as an individual strategy, you see. So that's probably why the number is as high as it is.
You would like your models working across all markets, though. I mean, if that model works, you want it working at all markets.
When you're doing the testing, you want to see it apply universally, I think, across all markets without much variation. Actually, without any variation. So that's step one. After that, you may go in there and take a closer look at it. Because one example clearly is that there's a lunch hour in Asia in Hang Seng. Hang Seng takes off for like an hour and they go to lunch. If you're going to trade that, you have to account for it. It's almost like a new opening, the second round. When they come back from lunch, it's starting fresh. Back in the day when I wrote Opening Range Breakout, I don't know if I took that into account. It may be something to take into account. Have 2 openings a day in the Hang Seng market. Well, that's a unique sort of construct. You have to take those kind of things into consideration. But the general principles apply. That's certainly what I've seen and tried to adhere to, is that because that's a more robust framework than when you're building these portfolios. There's not any clear-cut statistics that tell you what it is you're supposed to be doing with a strategy. There's just not that much insight in the stats. But what you do know is that if you can find something, a widget that can be applied in sort of a universal, general way, then you have something that's really, really powerful.
The phraseology you'd used years ago with me was a kind of an assembly line thinking is what you were, that automation and being able to apply it religiously.
Yeah, that's it's an appealing way of looking at it. Sometimes it really. I think what it does is it keeps you honest, when you're applying these strategies. So that's very important.
So, Toby, when you're talking with clients or you get the random elevator pitch, but you probably don't get too many of those, but or you have to give the random elevator pitch, people want to know, where did the profits come from for Crabel Capital Management? So, you've got counter trend strategies, you have momentum style strategies, you probably have others that I don't know about, but where philosophically do you see those profits coming from? Why are you able to extricate those profits from these liquid markets, liquid futures markets, et cetera?
Well, I think when we're successful, what we're trying to do is find areas where it's very difficult for participants to act. Places where there's market price action that aren't comfortable places for a human being to trade in the way that we're trading. And those seem to be the most profitable. And if you're a discretionary trader and you're doing that, either you're rewiring your sort of innate psychological disposition in order to do that sort of thing, or the fast track to this is to quantify it and then just let the machine do the work. But over time, a discretionary trader going against his nature, fear, greed, it will wear down because it's traumatic in a way. And that's where the automation is a real help. You need in order to get an edge, you need to do something that essentially nobody else can feel comfortable doing. I mean, there's got to be some people, but you may be the first, or you're very early on. So the recognition of that requires a little getting ahead of it a little bit. Seeing the market work itself into a position where it's vulnerable to sort of weak thinking that can take place because we are vulnerable as humans. Maybe too philosophical, but the problem, you don't want crowded trades. You want to be there when it's very difficult for other traders to operate. And that's sort of the wonder of systematic trading, I think. It's a real benefit. But that said, we tend to try to find the times when it's right to go against price action. And then, as my early work would suggest, I also was looking for times when the market is ready to move directionally in any given, day, and isolate those environments. It's an interesting area of work. The markets are different at different points, and that has to be taken into account. You have to. It's almost as if there's two separate, but there's more than that. There's many different environments, but traditionally our portfolios have been separated into at least two primary areas of mean reversion and momentum. It's our job to find out when it's right to do that.
You've not strayed from price action. I mean, your firm is price action at its foundation.
Yeah, and everything else that kind of goes along with that. I mean, volatility and volume, and there's other factors I think that are primary in that. But price action is a starting point. Price is a starting point. It makes it easy too. I mean, you get a lot from just looking at price alone. There's a lot there.
Talk about volatility since you bring it up, and I think everybody knows in the last month or two, we've seen some significant volatility across the board, and volatility is something in a little bit of chaos, a little bit of markets starting to have that enthusiasm. That's not something. That's not a negative for your firm.
Well, it depends. There's winning and losing volatility. We prefer the winning volatility. At this point, what we have seen is this, and then it's changed a lot of things in our firm. That up till a few months ago, the volatility was at record lows in most of the markets. Foreign exchange market, the interest rate markets, even the stock market as it was rallying was on relatively narrow trade day to day. And so the volatility, the VIX was at a very, very low level until just recently. But with the foreign exchange markets perking up in the last couple of months, it's it's I mean, literally in most of the foreign exchange markets, euro currency, dollar yen, you had the lowest volatility range that I've seen since I've started trading, and those were relatively good markets for us to trade in the past. If the volatility gets too low, there's no movement, there's nothing to really take advantage of. You need price movement. What's happened though is all of the markets, starting with foreign exchange a couple months ago, have changed, and the volatility has increased at least doubled, which is a welcome to what we need, and for profitability, we need price movement. Now, the other thing, of course, we need is volume, and of concern is what happened in the last week or so with a lot of the markets when you had these very large price moves. The volume dried up significantly, and we haven't really seen that. That's a new phenomenon. I mean, it's sort of this early in a cycle of volatility. It's sort of a unique circumstance, which leaves a question mark for me as we go forward in the thinking that we're doing about allocations and the kind of risk that we may have in the market. So that's another story. But volatility has increased. It took a long time. I don't think this is going away. As markets contract like they did for as long a period as they did, it's my opinion that the volatility cycle is on the rise rather than declining in most markets. So something's up, my opinion. I mean, economically, I don't know what that is. I do suspect that with the amount of intervention that's taken place in the markets over the years by some of the governments that the U.S. in particular, it's created a circumstance that it can end up being very volatile, in my opinion.
Let me interject real quick there, because I think this is something central to your firm, and we talked about this when we first spoke, is the idea of shocks. And, when these volatile situations start, we can think back to the summer of 2007. It was almost foreshadowed what came into 2008. Now, of course, I'm not trying to make a prediction or anything. I'm just talking. But the idea of shocks, rubber band snaps, this is something you think about all the time. You're prepared for it. And you knew as a young man, and you saw this happen to other people, you did not want you didn't want to risk your career on price shocks.
Yeah, that's the truth. Well, we still have occasional bumps in the portfolio that certainly cause some sleepless nights. I mean, but look, I mean, the clients have a certain appetite for drawdowns. If you're within the range that you propose, and if you can adhere to that, you're in good shape. You're doing what you say you're going to do, and that's very, very important when you're endearing trust in a program like ours. So, but yeah, price. I think we could say just in this last week we've had something of a price shock. Every time you see those, you understand where your weaknesses are thoroughly. So that's an area of it. It's a learning. If you can continue trading through that and you're okay, you haven't had a huge drawdown or, hurt your clients very badly, you've learned something. And there are things that you can put into place that will protect you further from these kind of things and these kind of events. And then, of course, you try to think ahead at what can create real problems for the portfolio. But it takes a really thorough knowledge of what's in there and how the portfolios evolve. And there's a lot of production going on in our company, a lot of strategy development, and you have to stay on top of that and really understand what it is that people are implementing in the portfolio, and so to truly understand your risk. But that is it. Look, if I'm building a 50-year track record, I'm almost halfway there on this, which is, a goal of mine. You have to be able to get through those price shocks. those are the things that are lurking out there that can thoroughly put you out of business. And you're right. I have seen it before. It can be terrifying.
You started your career as a guy with higher drawdowns, much higher drawdowns. So you've changed that. I mean, like a complete opposite side of the coin. I mean, you've gone from high drawdown to, I think I was looking today, between a max of, let's say, 15 to 16% on your big portfolio.
Yeah, and it's been a long time since we've seen that. That's a pretty big drawdown. I think that would be a big drawdown now. So, hopefully our risk-adjusted return is improving. But when I was trading at the beginning, I wasn't thinking about portfolio management, and I wasn't really tuned into what a client would want from a portfolio. So risk-adjusted return has become the primary benchmark measurement for our firm. So certainly, we do want to have a consistent return, but a decent return, but we also want to do it in a way that in a less chaotic way than, say, the S&P in its long only position in the S&P. We would think that we would be far, far better than that. Our drawdown should be less, and our return should be higher, relatively speaking, than a lot of any instruments out there. So we really want to be at the top of the risk-adjusted group in the hedge fund world. I
think you told me years ago it was, and you might be less today, but 0.02% risk per trade?
Yeah, I think it is less, actually. Because of the more strategies you have, the less you allocate to each one. But that's part of the risk reduction in itself. There's diversification and low correlation between strategies, and the more you can bring on that are truly not correlated, it seems like the better.
I'd love to pick your brain just for a second and pretend this isn't like an audience question. So the trader out there, the would-be investor, and they love their one market, perhaps. They're only fixate on one market, perhaps a currency or perhaps just one equity index. And then when they start to trade, they put these huge amounts of risk on. Maybe they could get 5, 10, 15%, perhaps more into this one market of their net worth. Why don't you talk about, I mean, you've been testing systems and looking at these things for decades. Just give the big picture out of the gate why that's such a bad thing to do, to be fixated on the one market and to be extending yourself risk-wise. I mean, everyone should know instinctively if you start risking that amount, you can blow yourself out. A couple losing trades and you're gone. I mean, capital's not unlimited.
Well, there's the allure of the profit too on the other side of that. So it could be quite appealing, visions of change of life and quality of life if you can hit it on that trade. That's a problem. There's a gambling element, gambling mentality that's leading that. But I think this is part of the evolution of any trader. When I started out, I traded, you trade one market with one strategy. It's that. You have a partial strategy undeveloped. So, but as I've moved along, what I've done is I've broadened out that and tried to diversify through different markets and strategies. And we're still doing it. And I think we're trading 300 markets now, which is much more than I think when we last talked. That's 300 futures markets and foreign exchange. So, equities presents a whole area of diversification if you do it right for us. For the beginning trader, though, I mean, if you can imagine a discretionary new trader, he doesn't have the knowledge base, doesn't understand a lot of different strategies. He starts with one strategy. And I heard a quote from Richard Dennis. I think he was one of the Market Wizards books, that at the beginning of your career, you should be trading the smallest with the least amount of capital on the line, because that's when your knowledge level is the lowest. And as you increase your knowledge base, you can increase your allocation. I think that pretty much says it all. So to a new trader, it should be a learning experiment at the outset. And if you're experimenting, you don't do it with a large large amount of your capital. You do with a very small amount, just maybe represented, or you don't do it with any capital. You just paper trade. But you evolve into a more complex trader by, if you can stay, caveat on this, if you can stay in the game to learn. So you don't want to damage yourself. There's a lot of people who just drop by the wayside because they just cannot handle the loss if it's too big. Those traumatizing losses can take you out of the game. And if you're not in the game, you can't learn. So you want to stay in. You want to stay in the game. You do not want to risk so much that it just totally traumatizes you.
Was there a moment in your trading career where you felt like, wow, I'm at the point where I'm at the cliff and this could go drastically wrong? Or did you shift gears completely at some point in time and say, I'm just walking away from, we talked about having steeper drawdowns when you were younger. Is there any kind of moment that you could think back to, that kind of a revelation where you just said, wow, okay, I now know the direction. I see the space where I should be?
Well, I think that when I went and worked at Victor Niederhoffer's shop, it was very, very clear to me. It was a sort of an integrating moment for me because I could see the research platform that was the best I'd ever seen, bar none, and it was a great team that was working there, and he had hired very, very well, and I was just happier than could be to be working there with someone like Victor. Now, Victor has different risk parameters on his trade. That's another story, but as far as a researcher and a market philosopher, I've never seen anything like Victor Niederhoffer. He's an amazing man. And the fellows that work there, a lot of them I work with now, in fact, in my firm, we have 6 or 7 gentlemen that I had met back in the early 90s when I worked there. But whatever the 10 or 12 years, when I started in 1980 around the floors of the exchange, when I got to Victor's 12 years later, I had a pool of market knowledge that I'd kind of developed the hard way, and when I brought it into Victor's, it sort of came together for me. I felt confident that I could make something happen in the field. It wasn't that I wasn't profitable previously in the 80s, but it wasn't as consistent as I would have liked.
Might be a good time to interject just as a kind of a side note. And I know this a little bit about Victor's background too, enjoying the philosophy of Objectivism. And I believe you do as well. Would you mind commenting on how that has affected your business life, your life in general, your entrepreneurial life?
Well, in the 80s, I think when I started trading, I just got off the tennis circuit. I played in Europe for a few years, played team tennis there. And my philosophy, my view of life was a little bit different, and I didn't really, Objectivism, I came across what Atlas Shrugged in 1986, and read that, loved it. What it did for me was, this is the marvelous thing about Rand's work, is it provides a very clear-cut moral code. In fact, the only one that I've really ever seen that supports what we do, capitalist behavior, the capitalist system. And so for an entrepreneur like myself, I really felt it was essential looking back on it, it was essential to have incorporated that in my life. It changed my thinking. It justified my actions. Markets are very, when you're around the exchanges, you kind of look at your fellow trader, say some of the guys that came off the floor. These are some rough and tumble fellows that were around the Chicago exchanges, and I almost, there were times when I wondered whether this was really what my calling should be. In fact, a couple of times in the 80s, I went and interviewed for jobs as a tennis pro, and thank God I they didn't hire me because I may have been doing that. Of course, I would have found out quickly enough that probably wasn't what I wanted to do after all. When I ran across Ayn Rand's work, it was an integrating moment for me also, and it led me to Victor. Now, Victor has variations on his own position philosophically, and we all have our different views of things. Essentially, he was a free market thinker, and we met because of that. And plus, he was a racket guy, and he liked tennis players. So that I went out and played tennis with him quite a bit at the beginning. It was an entry, along with my book. It was an entry into Victor Niederhoffer's world. But those are huge, I think, very, very important moments for me. I can't say enough about it. It's still an important. You really can't justify, I don't think. It's very hard to. There's a lot of confusion, I think, philosophically, and look at the regulatory groups out there and the people clamoring the newest book on Flash Boys and the beatings that traders are taking at just about any level. And how do you combat that in any way without some sort of sound philosophical underpinning? And I think Rand's philosophy provides that. It's an excellent moral code, my opinion. It's a sane moral code.
Let me add back just one little bit on Victor, and I think it's interesting that everyone can read the press accounts from the last 15 years and whatnot, and many of those ended up being negative. And of course, he runs a very popular site, and a lot of people contribute there. But I think what's interesting is how many notable traders cut their teeth there. I mean, his brother, for one, many others that you can name off. So it's really interesting how many people really gained a toehold and a foundation. You could argue that you guys in some ways were another version of Turtles, perhaps, just a completely different setup. But I mean, there's a lot of people that came from being around him to have great success.
Well, Richard Dennis, I think when he had his experiment on whether he could train traders out of, create traders out of nothing, he brought in the original Turtles, and I think that was fascinating. The one commonality is that they're quantitative. Victor was running a business. He needed to hire people, and what happened is that it was a quantitative shop primarily. You learned the ropes when you went in there. You were at you work with the master. He was a powerful intellect when you worked with him. He was a professorial. He was tough. But he was a real teacher. Now, the Turtles are, I don't know. I don't know as much about that. But as far as the fanfare around them, I think some of those guys have done very, very well. They have a lot of volatility in their portfolios. But they are generally all quantitative, and that's the real similarity. I mean, you can teach quantitative work. It's something that is transferable, I think. Developing a portfolio is a little tougher. Victor never really taught portfolio development. I think Richard Dennis may have more. They diversified through many, many markets right at the outset, and I think that was some of the portfolio work that I do started with his allocation concepts that I drew from the readings and some of the Turtles that did talk about it. So there's basic allocation methods. It's a good starting point when you're allocating to a lot of different markets. But I'm lucky because I met a lot of these fellows. Monroe Trout was also came out of Niederhoffer, which is probably of any of the graduates, he's the most successful. And we don't hear about him much anymore. He's theoretically retired, but he was brilliant and did a fantastic job of building a business.
Hold on. Theoretically retired.
Yeah, I don't know. I can't tell.
We'll leave it at that.
So anyway, he's a great example. But we have, like I said, we have 4 or 5 portfolio managers in our firm that all came out of Victor's, and some of the best, I think, other than Monroe or Roy. So it's rewarding. It's a great group to work with. It's a wonderful sort of intellectual environment that we have that I'm very comfortable with. When I first started, I was a little lonely. I missed the guys at Victor's because there was a camaraderie and a very interesting. It was an interesting group of guys, and luckily I've been able to bring them on as time has gone by.
Hey, Toby, you mentioned 300 futures contracts today. And I think since we've been talking some of the quant style at the longer time frame, trend following models, and some of the shorter term models, for example, some of the guys that you mentioned that you got to know from Victor Niederhoffer's shop. I think there's another commonality there, which is the liquid futures markets. So many of the traders that everyone reads about and all the books, the Market Wizards books, futures trading. There was a tangible liquid. I mean, why don't you talk about futures trading for a second?
Well, I think it's the most liquid markets that we can trade, and I think that there's central clearing, there's objectivity. I think things are extremely visible. We can liquidate our positions very quickly if we need to. That's comforting, I think, to the clients. I think a lot of the best traders started there, or they gravitated towards these very, very liquid instruments, and their strategies were worked around very liquid trading instruments. And I think it's no mistake. I mean, you look at some of the most successful traders out there: Paul Jones, Louis Bacon, Monroe Trout.
The list goes on. Paul Jones, Bruce Kovner,
Jim
Simons, David Harding, everybody. Yeah,
they trade a lot of equities, but that's an evolution. I think they started with the futures markets in a lot of cases. So it's a great place to learn. It looks like there's opportunity there to a trader, I think, when they first enter the trading world.
You know, you're a pretty ambitious guy, Toby. We talked about that years back. Give some inspiration to people out there. I think sometimes people think that there's this tried and true method. There's this system that you can follow for life. If you just work for this guy, everything will happen. But as you've talked about in this conversation, it's not that. There's no straight line. There's no do this and you will win. But I think a lot of it, if anyone's listening to you, it's persistence. It's just drive. It's find that passion, find that calling, and stick to it, and know you're going to take body punches. You're going to take gut shots, and it's how you pick yourself up.
Well, yeah, and try not to get hit too hard. Stay in the game so you can learn. And the learning process. Look, we're all going to make mistakes. One of the most important things for me is that I was very clear. I needed to learn. I needed to feel that I could develop and get better. So my market IQ could expand and improve, and my understanding of the business could expand, and I could get better at it. It wasn't a static place for me. I think that and that's what has happened. I learned. And I think that we all do that. We have to know that at the beginning we don't have as much. We may be very, 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 very bright people that come to the markets. I can't tell you how many PhDs in the sciences are being hired now by these firms to come in and do research. We do it ourselves. We really look for scientists and people that have great quantitative skills. But without market knowledge, there's they don't really have anything. So that has to be developed, and you have to be able. mastery doesn't come in a year or two. It's a relatively long process. It seems like maybe a 10-year minimum anyway. If you're going to get to a point, and by the way, I mentioned that I don't think I've mastered this quite yet. I still have more work to do.
Hold on, the 25-year track record says something. I'm not sure what, but it says something.
Yeah, it's not bad. But look, I think we're really just that idea of trying to improve. In order to do that, you have to be passionate about what you're doing. You really have to love your work. It is your passion. So without this sort of constant fascination with what the market is, for me in this area, I think it's true in any profession. You find what you love, be thorough about that, and then you master it over time. And I really don't. There are certain limitations that we have on the planet. It's wonderful what we can do as human beings. I mean, we can actually get smarter by building our pool of knowledge, make better decisions through practice. I mean, trading isn't much different than hitting a combination of underspin and topspin backhands. You have to hit thousands of them, and you get better and better at it. That's what we do, and I think that it's sort of the human condition. And finding your passion and then mastering it, I think, is one of the highest levels of what we do, what we humans do on the planet. So it's I hope that conveys.
No, it does. Listen, I appreciate you taking the time today. I could keep you all day and just keep chit-chatting about all kinds of stuff. I do have one kind of last, we could keep talking, but I have one last thing I really kind of would love to touch on. And you've talked a little bit about who you admire and some of mentors, and we talked a little bit about that. I'm curious, though, for people out there, trading, business, philosophy. Clearly, you have a very strong philosophical perspective. What books do you really admire? What have you loved to read over the decades?
Well, if it's about markets, I think you have to look at Jack Schwager's Market Wizard books. I think gives you a great view of some really great traders. I think that's inspiring stuff. Reading about the highest levels of the profession. I think it's really, really important. It's the inspiration, that's the food you need to go forward. I have to say, Ayn Rand's work, I think, the introduction to the OPAR, I think they call it, or they have a general text on objectivist philosophy that Leonard Peikoff edited and wrote, and it's a wonderful book, and I think it gives a very clear exposition of sort of a laissez-faire approach in the philosophy of objectivism, which I think is so helpful to anybody out there. What other books? Of course, Atlas Shrugged I thought was wonderful.
I'll interject one here as we're along this line of thinking. I'm calling you from Saigon today. So, Vietnamese girlfriend, I bought her the other day. She speaks and reads English, but I bought her the Vietnamese version of The Fountainhead, and she went through it faster than lightning. She seemed to really enjoy it.
We have a winner there.
Yeah.
That's great. That's a great book.
If you get through The Fountainhead fast and you love it, I agree, right? Yeah.
Yeah. I would also recommend Victor Hugo's work. It's some of the most beautifully written stuff and inspiring things that I've ever read. So, but at any rate, that's all part of our mastery, is reading as much as we possibly can. It's something it may be a lost art these days, but with all the electronic stuff.
I'll still take a physical book over a Kindle any day of the week. I don't mind searching for something on the Kindle. That's great, but I'd rather have I can read faster with a physical book. Everyone can, I would think.
You must be over 40.
Yes. Hey, Toby, listen, it was great chatting. Hopefully we can talk again in the future sometime. I'd love to have you back on. We could, I think people are just going to enjoy this conversation.
Sure. We'll do 10-year checkups if you want.
Well, I'm gonna have to bring it lower than 10. We can't do that. It's too long.
I'll be here.
I know you love giving some good philosophical bents, though. So, hey, people can go to check out your firm at Crabel.com, correct?
I believe that's right. Yeah. Crabel, something. Crabel.
They'll figure it out. They'll figure it out.
Something.
Yeah, they'll figure it out.
It's not a solicitation.
No. I'm just informational purposes. So don't send any crazy things to Toby and all that kind of fun stuff. So
buy my next book.
Is one coming?
Yeah, I think I'm working on it. I've got a few years into it now, so it should. The former book will be an appendix in the new book. So because and then it will be updated, but there's a whole storyline on that too. I think I will publish something down the road here. I'm working on it.
Cool, awesome. Yeah. Hey Toby, it was good chatting with you again, and I appreciate you taking the time today.
Thanks, Mike.
Good talking to you. See ya. I help people. I help them to learn about, understand, and execute trend-following strategies. Where should you start? Number 1, my podcast. 250 episodes. Dive in. I'm talking Nobel Prize winners, top fund managers, top traders, behavioral psychologists. The insights you need to get ahead and make money. Number 2, my website, trendfollowing.com/resources. Free trend following white papers and a free email update from my firm. Number 3, my books, including Trend Following, The Complete Turtle Trader, Trend Commandments, and The Little Book of Trading. Some bestsellers in there. There's a reason why. I'm not being cocky. There's just information in those books that you will not find anywhere else. Number 4, my systems with personal training at trendfollowing.com. For those of you that want more, for those of you that want to ask questions, for those of you that need specific insights, I go the extra mile with my systems and my training. Lastly, I will also send you, free of charge, a trend following CD of extras. Simple deal. Review one of my books on Amazon.com or write a review on iTunes. Then send me a mailing address. That's it. I'll send you the CD. I have one last bit of advice. Don't trust the state to take care of you. Do it yourself. You'll have a much better life.